Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, ANZ profits hit by housing and the Royal Commission, but not a permanent problem, according to CEO Shane Oliver. The first of the big bank results in line with expectations, and shares closed up 1.5% in a slightly off market. But we ask just how you shrink to greatness in a cold climate. Healthscope defiant under pressure at its AGM with a first strike on its REM report, but the board still holding out on any decision to allow due diligence by the BGH Private Equity Consortium. Trick or treat for investors. Our interview with Healthscope CEO Gordon Ballantyne direct from the AGM. And just what is behind the investor fury at AMP's controversial sale of its life insurance business? And will it make any difference? We speak with the author of that excoriating letter to the AMP board, Merlin Capital Partners, Neil Margolis. Well, look, it's a huge corporate news day in Bankland. We had the ANZ full-year results, but also today, Commonwealth Bank did more shrinking to greatness by announcing the sale of its global asset management business to Japan's Mitsubishi UFJ Financial Group for $4.1 billion. And then we've got the embattled AMP fending off this fury from investors. Well, joining me to help unpack it all, Chief Business Reporter Leo Shanahan. Leo, what do you want to talk about first? There's so much action.
Well, look, it is interesting, isn't it? I mean, obviously, you'd think the story of the day would be the ANZ results, but there was kind of, I think their thunder was somewhat stolen by the announcement by CBA that they'd sold the international funds management to Mitsubishi.
No, they wasn't. I mean, I should say we've got our interview with Shane Elliott coming up for ANZ, but one should say that CBA, this wasn't originally the plan, was it?
No, it's about, I think, the third incarnation of a plan now for this business.
So what does that say, do you think?
Well, I think it's that they would just sell it the best price they could get for it. And the idea just evolved, and obviously it's a good price. Look, initially they wanted to spin this out, well, put this up as an IPO individually. Then they were going to join it in the spin-off group with Colonial first, the other wealth management businesses and a few other things, and the mortgage broking business. And now Mitsubishi have come along and said, oh, we'll take that, thank you very much. And look, it's a good price. Look, $4.1 billion, it's 17.5 times last year's earnings. So look,
so
obviously,
what's left?
Well,
Does that mean they still have other bits?
Well, what's left is bits and pieces, really.
Yes.
I mean, it's interesting. You've got Colonial First State, Count Financial, Financial Wisdom, Aussie Home Loans, and CBA's minority shareholding.
So is that big
Plus.
enough to be sort of, I don't know, spun off, IPO'd off in itself?
Well, who knows? I mean, you could actually get another incarnation, a fourth incarnation now from CBA. Now that such a large chunk, the CFS GAM. I don't know what the latest name will be, but it's interesting as to what they might do, because obviously this shrinks the value of that potential spin-off significantly.
Now, bizarrely, or not bizarrely, but coincidentally, Japan's Mitsubishi UFJ has an interest in AMP. Yeah,
apparently they spoke to AMP prior to the purchase. Okay. So it is interesting as to
where... They've got 15%?
Yeah, they've got 15% of AMP capital. It would be interesting to see what they do with that 15% now. Are they looking to sell that, or are they in the business of acquisitions now in Australia? And they could see maybe some value in AMP. Would they buy up more of AMP? Are they going to consolidate that business somehow?
But surely they won't sell AMP capital. I mean, that's part of their future strategy, having offloaded the life.
Well, yeah. I mean, it would be interesting, though, to see what Mitsubishi's strategy would be for AMP and the Colonial International business.
Okay, which brings us back to ANZ results. Now, I think they were pretty much in line, but really interesting, Shane Elliott disagreed with the RBA's comments yesterday. On a deputy governor saying that actually she thought that there was a permanent impact on profits going forward from the Royal Commission. He said no, he didn't think that was going to be ongoing. There would be a small amount of impact, but in the short term rather, but not ongoing. What do you think?
Obviously we'll hear more from him in your interview coming up, Ticky. But look, it's interesting. Obviously, I think Impact from the Royal Commission is one thing. I think you have the short-term costs associated with fines, repaying customers, and possibly other regulatory costs. For example, NAB set to report what are those costs going to be from a case being brought by ASIC,
hopefully we're going to find out a bit more about that from Andrew Thorburn tomorrow.
But then you've got other costs associated with, I mean, you know, is there going to be a restriction on, in a structural sense, of the way in which banks lend out money? You can't have it both ways. I've said this before. You can't have an inquiry into cheap capital and irresponsible lending practices, and at the same time not expect it to hit further down the line. But there's also, I mean, more broadly as well. I mean, we've seen in the CBA's decision today, AMP doing the same thing. You can't keep cutting parts, and this is not necessarily to do with the Royal Commission, but you can't keep cutting parts out of banks, out of business, and not expect it to actually shrink the size of the overall profits, I think.
All right, well, look, Leo, thank you for your thoughts there.
Thanks,
let's go through those ANZ results in more detail. The cost of cleaning up from years of bad behaviour and a slowing housing market is crunching earnings at the bank, with cash profit falling 16% to $5.8 billion and net profit down 5%. The first cab off the ranks result is setting a bit of a gloomy tone for the remaining big banks, which have been suffering from the fallout from the inquiry into misconduct in the financial industry at the end of the property boom. ANZ also flagging its full-year results that it will not be pursuing an IPO of its New Zealand-based finance unit. It says the idea was scrapped after a strategic review, however, adding it may still consider a future sale. And for more on those results, I did sit down with ANZ CEO Shayne Elliott just a little earlier. Shayne Elliott, it's great to talk to you here. How would you describe the second half of these results?
Well, the second half for our business and institutional in New Zealand was really good, and those businesses have performed strongly throughout the year. What we said was, here in Australia, it was a tough second half, actually. It was challenging.
It's about as tough as it's been, isn't it?
Oh, it's certainly in living memory, that's right. There's been a confluence of all sorts of issues happening in terms of, you know, what we're seeing in house prices, the tightening borrowing capacity of people, rates rising a little bit. So there's a lot of things happening, and it has been a tough second half. Why should investors continue to look to ANZ, and indeed any of the banks, as a good investment? I mean, there doesn't seem to be much of a growth story. There's a cost-cutting story, and there's a dividend story. Well, we put it slightly differently. I think our story is about simplification. You know, we think actually in the new world, and this has been coming for a while and we've been talking about it, the world's going to be tougher. Customers are demanding more and things are changing at a faster pace. So the way that you win in that world is to be really adaptive, to be nimble, to be fast, to be innovative. And so we've been slimming down the organisation, getting ready for that. So we think there is actually a growth story. It may not be in this half, but there's a growth story here about being a better bank. And so we're confident around growth. And actually, there's a big cost story as well. We know that we've probably got lazy on costs over many, many years. We're 3 years in, 5 consecutive halves of bringing down our costs in absolute terms. Looking at the housing market in particular, which you talk about headwinds, of course, there, you've really focused back down on owner buyers, principal and interest. Now, we've still got this very soft outlook. We've got a risk of negative gearing changes if Labor get in. How do you see that market? So it's softening for all sorts of reasons, and it's probably a healthy thing. I mean, we've had sustained price rises, particularly in New South Wales and Victoria, for a period of time, so this is a pretty normal part of the cycle. So I think that's okay. It's right to be cautious. I do not think this is the time to really push the boundaries in terms of lending into homeowners, but we've said, hey, we know what we do well, and from a risk basis and just where we can add value, we really want to focus on owner-occupiers. Isn't that where the market's going anyway, where everyone's chasing that market? Possibly. I mean, I think we've been the most kind of focused on that for longer than others. There's still a market out there for investors, and that's a pretty competitive market, and we do it as well. We just don't think that's where we can win and do anything particularly special. So one of the reasons that vertical integration in banking actually happened all those years ago, with people like David Murray kicking it off, is because they were offering investors alternatives to being totally exposed to the housing cycle. It would appear that we've come full circle now, and that's really what you're offering investors. Well, possibly. I mean, I think what's happened over 30 years is the environment for banking was really good, right? You had high returns, pretty benign credit for most of that period of time. And so it's reasonable that the reasonable strategy in that was just to get big, you know. So, you know, do as much as you can with as many people in as many places. And that was the strategy that people did, whether that was vertical or horizontal integration. The world's changed now. I don't think that that is the right strategy. Growth's going to be lower, right? Customers are more discerning. There's more competition, different regulation. So we think the way to win is not to get bigger, it's to get better. And the way to get better is do a few things and do them well.
So another thing that's changed is the level of government intervention. Now, there were questions today on the possibility of further government intervention beyond a bank levy. Indeed, how banks manage their cost of funds on mortgages between their front book and their back book, given that there's this idea that borrowers set and forget and banks can take advantage of that. Do you see a risk of the government jumping in and saying, no, you can't do this anymore? And what would that do to the business?
So, look, I don't know what the government or governments might be thinking in terms of that. I think you're right, the fact that there's more scrutiny on our industry and that's going to lead to changes, partly through the Royal Commission, partly it may be through other policies. In that particular case, I think we need to be really cautious. I mean, the reality is you start tinkering with that, and maybe it's the right thing to do, but there can be massive unintended consequences there. Because what we're basically saying is, hey, we're unable to price our product on a risk-based individual basis. So if I offer Tiki a discount on something, I have to offer it to everybody that I've ever done business with. That would be a pretty radical thing to do, and I think the losers there would actually be new borrowers.
Let's move to the Royal Commission, the remediation you have done. I think you've got a team of 160 working on it. Now, your CFO says it's hard to look at whether there will be much more provisioning. Where do you sit on it?
Right, so we know what we know. We've got a big team, and it's a growing team, unfortunately, having to work on remediation. And it's not something we just started with the Royal Commission. We've been doing this for a number of years, but we're getting better at it. Obviously, well, maybe not, but what we do is we focus on where is the most likely things that are broken. So we look at the products and services that have lots of customers, or the products and services that are just inherently really, really complicated. That looks like somewhere that's something that have gone wrong.
That first.
So I think we've done a risk-based approach. We've hit those first. Now, as we move through, we'll still find things, but the chances are they'll be smaller in nature and less impactful. Well, but we don't know until we get there.
Michelle Bullock yesterday at the RBA, she said the costs of dealing with misconduct for all the banks will permanently affect profits.
I'm not so sure that I agree with that, and the reason it will affect profits in the short and medium term. The reason I don't believe with that is that actually the answer is simplification. If we do a few things and do them well, I have simpler products, I have less fees, less charges, less complicated things that I do. It's easy to get them right. So I don't know that complying with the law and complying with what we promise to customers is necessarily an expensive exercise. So I'm not so sure. I believe it's totally aligned with our strategy, actually, of do a few things, do them well, be simple, be low cost, just be really easy to deal with.
Part of that strategy, obviously, has been selling off a number of assets, and you've been going at this, as you've mentioned before, longer than any of the other banks,
yes.
Really. You do have the sale of ANZ Super, which is looming, to IOOF. Now, that's supposed to finish, March? We've got the Royal Commission coming down in February. Is that going to happen?
Well, you know, we've announced the sale. The only real next step in there is that the trustees, who, I don't have any influence over, they're independent, they have to make a decision that this is in the best interest of those fund holders. That will happen in the coming weeks and months. That's a process they go through, and they'll make their decision independently.
Yeah. Shane, can I ask you, in this new world that you have, about Agile? Because Agile was launched in, when was it? The heady days of 2017, right? So now you've got all, I would imagine that at this time of conservatism, shrinking to something more simpler, that having a whole bunch of different exciting Agile teams would be like herding cats.
No, I don't buy that. I think the idea, and it's easy to have that view that says, hey, in a world where compliance is at the fore, we've got to do, be really responsible, that actually command and control structure is the best way. I don't know that that's right. I think actually I believe in our people, and I believe if we give people more accountability and we delegate more authority for decision making to those people, they'll do the right thing. So I actually think it's totally aligned with what we're doing. It's really exciting. I know it's easy to kind of make fun of it, if you will, in terms of some of the language that goes around in the processes.
You're a great people person, obviously, known for that. Your team, how is your top team? Are they all getting on? Are they all, happy with Agile and happy with each other?
Well, we've got a great team. We've got a really diverse team, actually, in so many levels. We haven't worked together as a full team. It's really only a year since the last members joined. What I really like about our team is the diversity. I got people who come from tech companies, from investment banks, from consulting firms, from ANZ, and from other international banks. Yes. So we all bring different perspectives. We don't always agree on everything. You wouldn't want us to. But what's really good is we have a pretty open and transparent relationship.
But it's working for you. Your executive team's working.
I am absolutely right.
Okay. Terrific. Look, I must ask you about dividends. I mean, you've announced continuing dividends, right? Yes. You're in the middle of this buyback.
Yes.
Now, you'd rather do buyback than more dividends because of your franking credit situation.
Yeah, so look, we've got a significant surplus of capital at the moment. We're running at 11.4% in capital. We only need to be at 10.5% in 2 years' time. And we've got more money coming in, remember, from sales that we haven't got the money yet. We've got another $3 billion coming. So we're awash with capital. And our business is profitable. We just organically are doing well. So we need to figure out, do we use it to invest in our business? That's our first priority. But if we have surplus, how do we get it back to our shareholders in the most efficient way? One of the things one of our binding constraints is we don't have the franking credit balance that allows us to permanently increase the dividend or even to do a special dividend. If we did a special dividend unfranked, that means we have to unfrank all the dividends. So that's not really an option for us. So we look at these options every single half and do the best thing we can for shareholders.
Shane, final question, one I do need to ask you, is the other thing looming next year, of course, is the cartel case, the ACCC case against ANZ, this $2.5 billion raising, and also Citi and Deutsche. Now, your Treasurer, Rick Moscati, has stepped down. Now, you were Chief Financial Officer, though, at the time. Are you a clean skin in this, and how do you think it's going to turn out?
Well, I'm not. I have no involvement at this stage. I've not been asked. I'm not. I'm not in the case at this point. I don't know whether that will change and they want anything from me. But no, I'm not named in the case at this point.
How do you think it's going to go? Because I mean, it is the most unusual case, I suppose.
Well, exactly. It is a really unusual case. In fact, there's no international precedence for this. I think the industry has been, frankly, quite shocked about this and what the implications are for the market's ability to raise capital. So I think there's a lot of very concerned investors and corporations out there. We very strongly hold the view that we have done nothing wrong. We will be vigorously defending ourselves through the court process and vigorously defending our employee as well.
Shane Elliott, thank you so much for talking to me.
Thank you.
After the break, a big day for Healthscope today with a strike against the company's remuneration report and BGH upping its stake in the company. We'll hear more from CEO Gordon Ballantyne next.
You're watching Tiki on Your Money. Now, back to Tiki.
Welcome back. Well, the long-awaited TPP, Trans-Pacific Partnership trade deal, has been ratified with Australia signing on as the sixth country, meaning tariffs will begin to be cut within a couple of months. Well, for more on that and a few other things, let's bring in Sky News political reporter James O'Doherty, who joins me live from Canberra. James, g'day there. Now, look, actually, before I mention that, we should just mention Jennifer Westacott, head of the BCA, at the press club today. She was giving both barrels, wasn't she?
Yes, she was. Jennifer Westacott lamenting the fact that these large company tax cuts couldn't pass the Parliament, the fact that the government couldn't get support from Labor and the crossbench to pass their big business tax cuts. We know that they've passed their small business tax cuts, brought those forward by 5 years, but Jennifer Westacott lamenting that the company tax rate for big businesses will remain high.
Look, it's bitterly disappointing that that didn't get up. And I think it's a terrible mistake, a colossal mistake that the Parliament has made. And we'll see in 10 years' time how well the Australian economy fares as country after country after country lowers their rate and draws in more investment.
Yeah, well, that's been such a battle for such a long time, but we are in the election campaign and it's all about good news and the art of the possible, I suppose. Now, good news, I suppose, for the government today, which is that we are now officially part of the TPP.
Yes, that's right. The Australian government becoming the 6th government of the TPP 11 countries, or the CPTPP 11 countries, to ratify this deal, which means that Australia will have more avenues opened up to them in terms of free trade, places like Japan and the other countries that are first off the blocks, as it would be with the TPP. The ratification process actually going through New Zealand, Tiki. So Australia presenting its ratification documents to the New Zealand Minister of Trade, who is coordinating this whole thing. Our Minister of Trade, Zoran Birmingham, saying that it will open up more markets for Australia and be ultimately good economic news.
The national lift to Australia's national income is estimated to be more than $15 billion per annum by 2030. And what we're going to see there is year-on-year, multi-billion-dollar increase in our national income. In Canada, we're going to see tariffs on Australian wine eliminated, giving, of course, Australian winemakers great access. And the TPP is the first ever free trade agreement we've had with markets like Canada and Mexico. So it's great news for those types of producers and many, many more.
Glass half full for Burma, the Trade Minister there. But there was, I guess, signs that all is not completely happy on the education front with, you know, that issue that came up during the Wentworth campaign, which is about the treatment of same-sex, not so much the kids, which was dealt with, school kids, but with the teachers. Now, what's been the response of the religious schools and how's that playing out?
Tiki, this has been a problem for the government for some time. In the lead up to Wentworth, we know that that leaked Ruddock Review into religious freedoms had some commentary about whether or not religious schools should be able to expel gay students just for being gay. Well, the government and the opposition have more or less dealt with that, saying that's not appropriate, and students should not be discriminated against on the basis of their sexuality, though. Teachers, though, well, they're now in the spotlight with religious schools saying they need the current provisions to remain in place that allow them to hire or fire teachers based on their sexuality, whilst the government works on a more broad-ranging religious freedoms protection, potentially a religious freedoms bill. The problem is, for these religious schools, with 34 Anglican schools today writing to the Prime Minister, the problem is that they think they need to be able to employ teachers who portray and demonstrate the ethos, the faiths and beliefs of that particular religion. So if a teacher is gay or living in a gay relationship or in a gay marriage, some schools don't believe that that teacher will adequately portray the ethos of the religion to the school children.
James,
so
does
the schools
this
say they
hit,
need these provisions to remain in place.
Does this hit grassroots in both on the Liberal side but also on Labor side, or is this more of a sensitive issue for the government, do you think?
It'd be more of a sensitive issue for the government, Tiki, although Labor is in a bit of a tough position as to what they do with it. Labor says that they don't want teachers to be discriminated against on the basis of their sexuality. Labor, though, does believe, many people believe within Labor, that these schools do need the right to be able to hire people based on the ethos of the school. So Labor says that's a separate conversation that they can have after the government's full response to the Ruddock Review is released. But what's really happening now is the government's scrambling to decide what to do with this. The Ruddock Review they've had since May, they still haven't released their final actions on how they're going to respond to it.
Yeah, tricky. All right, James Doherty, thank you very much for all that wrap. Well, moving to company news now, and BGH Private Equity Consortium has increased its stake in Healthscope by more than 2.7%, bringing its total interest to just shy of 20%. Australian Super has also upped its stake in the takeover target, and it comes as Healthscope holds its AGM, well, giving the company the opportunity to crow about its Northern Beaches Hospital in Sydney opening yesterday on time and on budget. Well, as viewers will know, we've been following this story with great interest. Healthscope today says it's targeting targeting at least 10% earnings growth in full year 19, after operating earnings growth of 10% in the first quarter have been achieved. Now, the company is pushing ahead with plans to create a property trust, saying it's begun the search for a co-investor. It's all part of the company's plans to mount a credible defence that the current board and management will deliver value to shareholders when it's weighing up this other bid. But there's no doubt the pressure is on. Today was also a bad day for Chair Paula Dwyer, with the company's first strike received against its remuneration report. Well, for more on what went down, Your Money Chief Business Reporter Leo Shanahan spoke with Healthscope CEO Gordon Ballantyne from the sidelines of the AGM in Melbourne.
Gordon Ballantyne, thanks so much for joining us.
It's great to be on the show.
Gordon, it's been a huge week for Healthscope. Well, we're in the middle of a huge week for Healthscope. You've got the opening of the Northern Beaches Hospital, you've got the AGM, and in the midst of more takeover talk. Let's just begin on that. We understand that the board is yet to make a decision on whether to accept due diligence for BGH and Australian Super's bid for Healthscope. What's the rationale behind that, and what's the delay?
Well, there's no delay in many of these decisions. They're really important decisions to consider all shareholders, and we're in active dialogue with all of our shareholders. We have an unsolicited proposal. You know, part of today at the AGM was to update the market on our performance, which is a critical and important part of making any evaluation on a bid. And clearly today we updated the market that we'd reconfirm guidance of at least 10% earnings growth for FY19, which was really pleasing. And in addition to that, in Q1 we saw growth of 10.4%, which was a significant turnaround of the business since the prior period last year of a decline of 6.8%. So that's really important market information to inform the market. We've opened Northern Beaches Hospital. We've completed our Asian pathology sale. There's a lot of new news in the market this morning as part of our AGM update, which I think is important as a consideration as we think about the market, we think about the outlook, and reflect on these unsolicited bids.
Sure, but how can the board justify delaying due diligence given the value of the bid by BGH and Australian Super, and indeed Australian Super's shareholding in the company?
Look, this is a top priority for the Healthscope board. We'll take our time. It's a priority, so we'll do the due diligence and we'll inform the market accordingly. Okay.
Are you just buying time at the moment to get more support for this property trust, which is the, I suppose, alternative strategy for Healthscope at this stage?
No, I don't think that's the case. The board are listening to all shareholders. We're in a dialogue with all shareholders. We're really open to continue that dialogue. That's not the case. Clearly, the property trust is something we announced in May. We believe there's a significant value to be unlocked for all shareholders as we look at the 29 freehold properties across our 43 hospitals across Australia. And we talked this morning about the book value of that portfolio being around 1.1 billion, and with a market value of around 1.6 to 1.8 billion. This is significant value for all Healthscope shareholders, and we're well progressed in that regard at looking at an unlisted property trust and ensuring that we're progressing that structure and hopefully completing on it in the early part of FY19.
Yeah, I mean, what interest have you had in the property trust from other investors? Can you give us any insight into that progress?
Look, we've met with or communicated with over 100 potential investors, and we've met with a large number of Australian and overseas investors. We're pretty excited by the interest and support for the unlisted property trust. Clearly, an important part of that structure is we're looking for a partner who will be up to a 49% co-investor with us, because retaining control is really important. Containing control to ensure that from an operational perspective that we're in control of the future investment in our hospitals and the quality of care we deliver to our patients. And that's why we've structured the unlisted property trust in the way we have.
Just finally on the Australian Super and BGH bid, does it concern you, this partnership of Australian Super, who have such a dominant role on the register, as well as a private equity company? Does that kind of conflict concern you at all?
Look, that's a question perhaps you should ask BGH and Aussie Super. I'm not commenting on that particular structure.
as a more general, I suppose, proposition, the idea of industry super funds and private equity teaming up, is it concerning?
Look, I don't have any comments as it relates to that combination. Clearly, Aussie Super is a very important shareholder of ours, and it is also part of a private equity-led consortium, and we have to engage appropriately with both our shareholders and with the unsolicited bid, and the board has to come to some decision with regard to a decision around progressing that.
Sure. Now, look, I understand there's been a first strike today at the AGM on the REM report. What does that say about shareholders' confidence in the board and the chair, Paula Dwyer?
Look, I'm not here to comment on our chair. She's done a great job leading this organisation, and I'm not here to comment on REM report. That's a question for our chairman.
Sure. Now, the Northern Beaches Hospital opening this week, that's a big achievement for Healthscope, obviously. How is that going? Have you hit any snags yet? Are you happy with how the opening's been going the last couple of days?
Look, we're extremely excited about the opening of Northern Beaches Hospital. You know, it's an $840 million investment building a 450-bed hospital that serves the local community in Sydney of Northern Beaches. I think there's a huge amount of excitement around the opening of the hospital. It's 4 years in the making, and we've managed to open that hospital on the day we said we would, on the 30th of October, 4 years ago. I mean, we're just incredibly excited. The support we've had from doctors, clinicians, all our staff, it's an extraordinary achievement. And of course, underpinning all of that is, you know, a whole new quality of care we're delivering to the local community, which I think is really pleasing. Part of that is also that, you know, over the next 4 to 5 years, as that hospital ramps up, as we serve both public and private patients, we'll generate around $300 million of revenue. So it's the cornerstone of our future growth plans. And I think, you know, that's why we're excited about Northern Beaches. And I perhaps think that, you know, some of these people knocking on our door, perhaps that's why they're excited as well, to see that future growth, future potential, future value.
All right, Gordon Ballantyne, congratulations and thanks so much for joining us.
Thank you very much for your time.
Well, it's getting very interesting, isn't it? Because they're not going to go away, looking at the rise in share price from Aussie Super and BGH. So we will continue to follow that one. After the break, Merlin Capital Partners sends a strong message to AMP. Neil Margolis, founder of Merlin Capital, joins me next.
This is Tiki on Your Money, covering the big business stories.
Yes, welcome back. And now to a really interesting and developing story about AMP. Now, AMP is defending the price tag of the sale of its life insurance arm after a fund manager threatened to campaign for a board spill over the sale of the business of over $3 billion. Incoming CEO Francesco De Ferrari at AMP has promised that the board would return most of the net cash proceeds from the sale to shareholders. AMP shares have been hammered by capital outflows and fleeing shareholders in recent weeks after revelations from a Royal Commission found abuses in banking and insurance industries, revealing deep flaws in governance and ethics. And shares fell even further last week on the news of the sale of AMP's life insurance business to UK's Resolution Life at nearly a fifth below book value. But today, the shares bounced back, I think almost 7%. Well, the fund manager which penned the letter attacking AMP's strategy on the fire sale of life insurance is Merlin, and Neil Margolis from Merlin Capital joins me now. Neil, it's great to have you on the show. Now, look, they feel that they have come, AMP feel that Mike Wilkins, he's come back on your letter. He says perhaps he feels you're a bit factually incorrect.
Well, yeah, we will take offence to that. I might just firstly say that, you know, the issue here is, I know that we own shares in AMP and we're long-term investors, so it's always difficult to, you know...
Well, you make the point in your letter that you've got skin in the game, unlike half the
We
board.
do. So the decision was, and some fund managers would say this is going to do more damage. We don't believe it will, because this has got nothing to do with the customers, and in our view, nothing to do with the Royal Commission. This just has to do with the directors selling the business at a very poor price, and the disclosure wasn't good around that. And the question now is, can we get out of the deal, number one? And number two, if we can't, can we at least have the money back rather than get spent on other deals which will destroy shareholder value?
Mr. Wilkins not said that the money will be coming back to shareholders?
Yeah, there's a few things to peel back here. I guess if you look at the letter we wrote, and we sent it to them on Saturday night, we thought we working on Saturday night, they may as well. And the things we looked at were primarily initially around disclosure.
Yep.
So how bad is the price? And their disclosure today actually proves that our analysis was exactly accurate. So what they said in the Fin Review, that there were some inaccuracies. You said they sold at 1/5 below, they sold at 2/5 below. Okay, and that's what we said in the letter, and it's exactly what the analysis says today. So
yeah. Now, is that around? You've got a graphic here, I think. Have you got a graphic that we can pull up on?
Yeah, I don't have it on me. No.
Okay.
No,
all right. Okay. Well, if just going to that difference in value and clarification, that was all about the franking credits, which were essentially, I think the Fin had it saying it was torched.
Two
in
things.
what way?
Yeah. So they said they sold at 1/5 below, and when you say below what, it's below what we believe is a conservative actuarial valuation from a bunch of very smart actuaries at AMP that have been there in some cases decades, and they said the business was worth this, and we believe the directors formed a more pessimistic short-term, long-term view. Who knows? But it's a different view to the actuaries. And I think in the end of the day, you've got to say that there's a team of people at AMP that produced these valuations as recently as August.
Yes.
So they said they sold 1/5 below, but they actually sold 2/5 below, and it's two things. It's the franking credits, and they disclosed there's $700 million that they're going to give away that the UK buyer can't use. Yeah. So, but that's a direct transfer to the tax office because AMP shareholders could use that.
Yeah, so Mike Wilkins has come back and said, oh, well, look, this is actually franking credits based on the future earnings and future. It's all a bit hypothetical, those franking credits sitting there.
Yeah, look, we don't know all the facts. So the first thing was the price is not is worse than you said, and they've basically confirmed that today. The second thing is a bit more disclosure about how bad is this life insurance business, and I want to hear from the actuaries there more than the directors, because I think they're the ones that, quite frankly, is a very considered view, long-term, same methodology, and what we've asked for is for all the cash flows that the actuaries expect to come in future to be disclosed to the market, so we can form a view around that. The second form of leakage is around the separation costs. The franking is the 700 million,
yes.
And there's a 300 or 400 million about splitting out the businesses, separating the businesses, and of course there's some IT systems, but there's also banking fees for the advisors that wanted the deal done, and a few other fees. So those fees would not have to be incurred if they kept it together. They could rather put that into the life company as actual capital.
So as you say, they weren't considering more simple ideas, including just business as usual and not doing anything at all.
Yeah, look, no one has a crystal ball. The directors are now being quite pessimistic on the outlook for the life insurance business. Yeah. But the point is that disclosures...
It's a very tricky business. They haven't got the global scale like some of the big competitors. You don't buy that?
Well, I mean, I guess the issue is that there's two values of the business. There's the value of the policies you have written, and that's what we're talking about, and then there's the value of future new business. And the future new business, they've already said, forget about that. And we think there's still a chance of that. But even in what they've already written, it just comes back to you can put up prices, and you've got to estimate the claims, or the actuaries are to estimate the claims. And if the claims are worse, the prices go up, and that is happening. And when the major banks are all rushing to exit, it could be a good sign that maybe it's time to stay in it, particularly because it's a bigger part of AMP than the life insurance company is for the banks.
Well, and of course it's got all that nostalgia hooked up with it as well, I suppose, but that's not a good reason to keep it, is it?
Yes, and saying the foreign insurers are going to be irrational because they've got lower cost of capital. I mean, interest rates are going up around the world. We might see that normalize. It's good to have the strategic option, but it's just the cost of giving it up in terms of the franking credits you give back to you give away, the separation costs, and then what was most interesting in their disclosure is about half the profitability of the life insurance business they were actually showing in the advice business, which is just an accounting entry. So what it really tells you, the life insurance business was more profitable than it appeared.
Right, and the other business was less.
Possibly, but the group as a whole was unchanged, whereas now the group is losing that. So the first piece was around disclosure, and they've actually agreed the price was what we said, not what they said. The second piece is the business that bad? Can we see a little bit more about it? And then the next thing we asked is, can we get out of this deal? Now, it's a low probability, but it's not a zero probability.
So, Neil, you've got support from Simon Mawhinney, from Alan Gray. What about other shareholders? I mean, are you going to push for an EGM? You need, what, 5%, don't you?
Yeah, look, we want to avoid that. I mean, in the end of the day, it's not in anyone's interest to destabilise the board further. You know, and you've got to know what you want to achieve out of it. What we want to achieve is in the letter, and it's very clear. We want a disclosure for them to admit the price was poor. That's happened. The second thing we want is a bit more disclosure around, you know, how bad are these businesses really, because we don't think they're that bad. And then can the deal be, even at a small cost, can the deal be unwound? And we've asked for that, and we want, it's black and white. And there's around the ASX approving the deal is an interesting angle there. But then I guess that the more interesting thing is the capital. So if the deal can't be changed, and look, most likely it can't, most likely it's going to go ahead.
Yes.
If it can't be changed, can they please commit to giving the capital back? And as you said earlier, they've committed to some of it, but I think there's more clarity required there.
Okay. Well, what do you think is going to happen as, you know, a significant shareholder in AMP? What do you think is going to happen in February when Ken Hayne comes down? I mean, are you worried about Kenneth Hayne recommending that basically some of the business models of AMP, like the platforms or whatever, could actually be completely blown up?
Yeah, no, look, there's a range of outcomes for everything, and I guess the issue is not what are the problems, it's what's factored in, and we believe a lot of negativity is factored in, you know, in the current share price. About a third of the market value is surplus capital now that they've received, even though it was a poor price. They will have their hands on the cash, and that can come back. But by
keeping the life insurance, would that have been better, looking at the potential downside scenarios for Hayne, or worse?
I agree with you. I think with some of the, look, we think the most likely scenario, you know, is the business will be less profitable than it's been in the past, but it's still a viable business. There's 130 billion of funds under management. There's 2,500 advisors. Everyone's focusing on the advisor numbers reducing, but it's the 80-20 rule. Some of the older ones that need to be re-educated, you know, are moving out. That's fine, but there's the younger, successful ones that are profitable. We think it's a valid product and a valid service, providing, you know, the compliance, everything else, and we think there's value there. The life company's got some short-term problems, but we think, you know, the cost of separating it is too high, or we don't know. We need to see more disclosure. But if this deal is done and dusted, and that's probably still a 90% chance it is, and then we want the capital to be preserved for us.
So this could play out, this is going to take a little while to play out, do you think, between you and AMP?
Well, it's not, again, I mean, we're trying to, you know, we don't want to meet them privately. We've made the demands public. We think all shareholders are entitled to see these demands. We don't think they're unreasonable, given that they're giving away almost half their earnings for quite a low price. So we're trying to, you know, not be crusaders, but we're trying to act in the interest of all shareholders, certainly our clients, and we think in the end of the day the directors do work for the shareholders, and we're just looking for a bit more information.
All right, well, Neil Margolis, it's very interesting to talk to you at this moment. Thanks very much for coming in and explaining it all.
Thank you.
Well, now let's go to the break. After a lot of pressure on next month's G20 summit, we'll find out why with Alan Oxley after the break next.
Now, back to Tiki.
Welcome back. Well, the next round of talks between the US and China on a trade deal aren't scheduled until next month, but the gamesmanship continues, with US President Donald Trump threatening to impose tariffs on all Chinese imports if a deal isn't reached.
In a sign, the US president is gathering more ammunition ahead of trade war talks with China next month. Donald Trump appeared to confirm to Fox News reports that Washington will impose tariffs on all imports from Beijing in December if a truce isn't reached.
We're going to win that one.
How confident are you about the deal?
They'd like to make a deal right now. I just say they're not ready.
$250 billion additional tariffs if that deal doesn't go through.
$250 billion and have $267 billion waiting to go if we can't make a deal.
Are you optimistic? Scale of 1 to 10.
I think that we will make a great deal with China.
The apparent posturing ahead of next month's G20 summit in Buenos Aires was not taken kindly to by China, who's already imposed retaliatory tariffs on Washington to the tune of $110 billion, saying its strategy has not changed.
China is confident enough to stick to our own path, to continue reforms and open up and develop ourselves.
Markets not liking the possibility of an even tougher battle between the world's two largest economies opened higher on Tuesday and then fell into a sea of red.
I think the markets are not overreacting, because if the tariffs are extended to all of China's exports to the US, then that would represent a serious curtailment of global trade. That would not be good news.
For Beijing, its currency moves could be of more immediate concern, though, in early Tuesday trade falling closer to 7 yuan per dollar, a 10-year low.
Well, for more on what to expect from those G20 talks, I'm joined by Managing Director of ITS Global and former diplomat Alan Oxley, who joins me live from Melbourne. Alan, I think it's a couple of years or so that we haven't spoken, so it's very nice to get you there in Melbourne. Now, you have been covering trade for a very, very long time. How do you see this big game going on between Donald Trump and Xi Jinping?
Yeah, well, Tiggy, the game is Trump's game. It's all very well for him to say he's going to do this at the G20 meeting, but last week he said he was going to hold off on all this until the end of the year. And this is pretty typical. It was a way in which he dealt with Canada and Mexico in his negotiations. So he just continues to roll up option after option after option with no intent really to take any action until he gets to the end game, and that won't be the G20 meeting.
Right, OK, so you're not expecting very much, or would you expect him to push it hard and then the Chinese to push back a great deal?
Oh, the Chinese aren't to be underestimated. I think they've got his measure. I think they know what to expect from him. And I don't think they're going to be willing to negotiate with him until they conclude that he's willing to negotiate. And it was the same model he used in the negotiations on the NAFTA agreement, as I said before, with Mexico and Canada. He spun it out, spun it out, spun it out, even to the very end of the sort of last day or two when Mexico joined and Canada said they couldn't. He said, "I will go ahead without them." But this is just his style. He doesn't actually take any concrete action until he gets to the end of the run. And he's not there yet, and he won't be at the G20 yet.
Right, OK. So are we going to go to $500 billion in tariffs?
I don't think so. It's and actually the trade relationship between the two countries is not as large as is generally believed. For the US, the amount of trade involved with the imports is only 4% of GDP. In China's case, they've got other major trading partners, so they can cope, they can manage. It won't be all that great, but it's not going to be the end of the world, which is the impression that I think that Trump would like to leave.
So if this all comes back to the original sore point from the US, which is about technology, I mean, I noticed the US Commerce Department this week restricting American companies from selling software and tech to another Chinese company, Fujian Jinhua, which is a bit like what happened with ZTE. I mean, is this really the sore point and really where Donald Trump's trying to get to?
No, there's gaming here. Trump had a very significant point to make when he grumbled that the Chinese, when American investors or foreign investors set up in China, were required to hand over the IT, and that was a fact. So Trump made a very big deal of that. But in April, with the BOA Forum, which is China's big annual conference, President Xi said, "We will cease that practice." Trump never responded. He's never said a word on that since. So you can see that where Xi was willing to make some concessions, which actually mattered, Trump's still gaming, and we're still seeing that now.
Yeah. Would it be right, though, as the US Commander-in-Chief, to take President Xi on his word on that front, do you think?
No, in short. I mean, we're dealing with a man who's full of colour, full of exaggeration. Even his own people don't really know when he's going to decide what he's going to do. The latest book that was written, which is, well, I recommend to everybody to read, from the White House journalists, describes the style and the technique. So he's just at this in the usual form, and I think the Chinese don't know what to expect. They're, I think, well equipped to manage this, and I think they'll simply wait until the time is ready.
Yeah. What about the future of the WTO, Alan? I mean, is that actually under threat, do you think?
It's not so much under threat as being put into limbo. He's been very destructive on that. He's got some complaints, but really he doesn't have any respect for the organisation, and I'm sure you've read somewhere he's refused to agree to allow fresh appointments for the review committee for juridical challenges, or whether people are complying with the laws and rules or not. And there's about 50 cases waiting to be queued. And Trump has simply said, nope, we're not going to go along with that. Now, that will stall. That will mean it won't happen. But I don't want to sound too cynical, but the UN, it's a bit like the UN in some ways and other international organisations. They never go away. So WTO will limp on for some time, but at least one thing that he's done, which is significant, is it has generated the need to focus on the need for reform in WTO. And Australia and other countries are starting to think about that. But the reality, I think, is we're not going to see anything significant happen here until he leaves the presidency.
Right, and where does this put Australia with this, China-US relationship?
Well, we're still a lucky country. We don't actually export much directly to the US. Our biggest economic relationship with the United States is investment, and they're a major investment partner. Our trade with the US is actually quite small. Beef is the main issue that we need. And I'm pleased to see that we've been able to continue to maintain an effective relationship with China. There's been some concerns with the concern about security questions, about whether China might have obstructed the trade with us, and it's extremely important. But on the trade side, while the Chinese are refusing to meet any of our ministers, it's business as usual, and that's something that we should take satisfaction from.
All right, now look, really interesting to get your views. So we'll look forward to G20, but not with great expectations. Before you go, I should just say this is staggering. Not only Alan Oxley, but Thomas Oxley as well. Dr. Thomas Oxley named the overall winner of the Advance Awards in 2018 and the Life Sciences winner. You must have been very proud of your son.
Indeed, he's much smarter than I am.
Well, I think it must be in the genes. Alan Oxley, thanks very much for joining us.
Thank you. Goodbye.
Well, that's all for the show tonight. Now, tomorrow night, NAB CEO Andrew Thorburn on the bank's full-year results out tomorrow. Until then, see you tomorrow night at 5 p.m. on Your Money, or tonight on Catch Up at 8 p.m. on Foxtel's Channel 604. Thanks for your company.